Hey guys, it's Chris. Wanted to give you a quick update on some things that are on our minds right now. 8 quick slides that I really want to share with you, kind of give you an insight into what we're thinking at a top level. I want to bring you back to October. That is when we decided to go at least put 1 foot back in the water. That turned out to be really good timing. It was a point that seemed like an inflection point. Why we didn't put both feet in the water? Look, 22 was an awful year, the worst we've seen since 1936 for a retail investor. And we thought that at that point, there was a lot of damage done. Maybe a good time to at least put 1 foot back in the water. What did we do with the other foot? You'll remember a lot of videos, a lot of communication about high interest rates. We took a large chunk, larger than normal, and put it into essentially 5% bonds. And we thought that was a good move. At least we knew that one half or a little bit more than half of our portfolios were getting this 5% interest. So our portfolios since October have looked conservative and continue to be conservative. We haven't changed that stance since October. And I've had some discussions with clients. Hey, Chris, when are we going to get back to normal? When are we going to dive in with both feet, jump in with both feet? And the answer is not yet, at least from our perspective. So I've had more conversations with clients on the opposite end. Hey, we're still nervous, we're still scared, we're still gun shy. And so I've got more people that are wanting to be conservative, but I also have people that are asking, hey, when's the right time to kind of get a more normal approach? So here's 8 slides just to kind of show you where we're at, what's on our minds. This is what's happened so far this year. That red line is basically what you would call the stock market. Okay, these are 3 different stock markets, but the red line is for us the primary stock market. January was this great year over here. We had, or excuse me, great month. It went up like a rocket. It was like, wow, is this huge? It's kind of sigh of relief from investors. And but since February 1st, we've just kind of stayed the course. We've done really essentially nothing for the last 3 months except kind of go up and down. So we're at this, I would say, turning point. There's a lot that could happen. Sell in May and go away is a long time adage that we've watched as investors. Sell in May and go away. What's that mean? It means once May comes, man, let's just get out. We've made our money. Let's get out. And we might be at that point. It's hard to say. A lot of people still talking about recession. We're still not out of the woods out of this thing yet. I think that for the most part, it's going to be continue to be kind of a choppy up and down year like we've seen on your screen for the last 3 months. This is a pre-election year, and those tend to be more volatile than most. So this screen, what does it tell you so far? Not too bad. January, awesome. Not really a lot has happened though since January 31st. So why don't we want to dive in with both feet right now? Well, the first thing I want to show is inflation. Inflation, everyone knows that it's not where it should be. That red line on the screen, that's 3%. If we can get under that 3%, that's going to give a lot of comfort to investors. But right now, although it's coming down, we're simply not there yet. We're not back to what I would call normal. Another thing that I really pay attention to, I've been paying attention to housing for 15 years, and I brought this up often, and it's probably boring for some of you who remember what I'm going to show you. But look, every gray bar here on this chart is a major U.S. economic recession. Every single time we've had an economic recession, what has preceded it? The housing market starts to fall. Okay, it's like clockwork. Housing market falls, we have a recession. Housing market falls, we have a recession. Look, right now, don't look now, but the housing market's going down. Does that mean we're going to have a recession? Not necessarily. We've been fooled before. Here, this is like 1967, 1966. The housing market crashed. No recession. Okay, so it doesn't mean we're going to have a recession, but when you see a pattern like this that has successfully predicted recession since 1960 and prior, you can't ignore it. Okay, you don't want to put both feet in the water when the housing market's saying, hey, look, we potentially could be having another recession. That's something we watch. The next thing, the yield curve. So this is interest rates. Very simply, right? You give your money to the government for 1 year, you should expect to get about 1%. You give it to them for 8 years, you should expect to get about 4 or 5%. Right now, it is completely the opposite. Okay, if you give your money to the government for 1 year, they're going to give you 4%. If you give it to them for 8 years, they're only going to give you 3. This is completely backwards thinking. It doesn't make sense. This is what's called an inverted yield curve. Okay, why do we talk about an inverted yield curve? Because every single time, again, we have a gray bar. These are recessions. What has happened every time before we've had a recession? The inverted yield curve has occurred. Okay, what do we have right now? We have an inverted yield curve. Again, I hope that the housing market is wrong. I hope that the inflation story is over. I hope that this inverted yield curve, it's different this time. We all hope that. But when you're seeing these signs, these warning signs that historically have been words of wisdom to investors, signs to be careful, we can't ignore them. All right. There's other things. Still not enough people back to work. Labor participation rate is recovering. More people are getting back to work, but not enough. We have over 10,000 job openings. How can an economy grow if nobody can find workers? We are not necessarily in a healthy position right now. Personal savings, to me, this one is scary. People are not able to get by on their paychecks. Okay, the personal savings rate typically historically has been right around that 5%. We save about 5%. That's a good thing. Of course, we had this spike here, COVID. Government was giving free money out. We've talked about that too much. Everyone had tons of money in their bank account. And of course, we've talked about the reasons why the government made mistakes. And you spent all that money on restaurants and Amazon, or at least the average U.S. consumer did. And now they're in an unhealthy position. Okay, it's getting better. But frankly, people are not, they don't have as much in their bank account as they normally do or normally should. Where is that money at? It's on their credit card statements, okay? Consumer debt is high right now, and that's just not a good thing. So, in short, the deal is 1 foot in, 1 foot and 5%. Probably in the next 30 days, we might relook at this, revisit this, see how May looks. We have big interest rate decisions still upon us. We still have a lot of people calling for a recession, and that some of these warning signs that I've gone over are concerning to investors. And look, they're concerning to us. So we're still feeling good about where we placed ourselves back in October, and it's very likely that sometime in 2023 we will once again go back into what I would call a normal portfolio situation and probably stick there for the foreseeable future. But for now, just kind of an update what we're looking at with the portfolios. Look, I got through 8 slides in 8 minutes and 23 seconds. Look, they say Chris Sear, the advisors should be making short videos. You should be knocking out these items in 2 minutes, and maybe they're right, but look, I have to be myself, and this video is going to be under 9 minutes. I want to be myself. I want to tell you what I'm thinking, and I guess there's just a lot on my mind. I can't tell it to you all in 2 minutes, so I hope you enjoyed just a little communication from me to you. I'll see you guys soon. Take care.